Good afternoon, and my name is Sharon Jagira. I'm the Manager of Community Relations and Marketing for Visiting Nurse and Hospice for Vermont and New Hampshire. Today, we're going to be talking about tax breaks for charitable giving with Mark Melendi from Sheehy, Furlong, and Beam. Mark has been with the firm since 2016 and is a principal of the firm. His practice focuses largely on corporate services, mergers and acquisitions, business succession planning, estates and trusts, and tax planning. After law school, Mark served as a federal clerk to the Honorable Franklin S. Billings Jr., U.S. District Court, followed by work as an associate in the corporate departments of two large international law firms, Paul, Weiss, Rifkin, Wharton, and Garrison, and Skadden, Arps, Slate, Meager, and Flom. Following his relocation to Vermont, he became a principal at Christensen, Cummings, Phillips, Carroll, and Melendi, P.C. in Brattleboro, Vermont, and subsequently Whittington, Melendi, and Girdwood, P.C. in Hanover, New Hampshire, and Woodstock, Vermont, before forming his own firm in 2003. Mark has attained an AV, Preeminent Very High Ethical Standards, Martindale Hubble Peer Review Rating. Mark, thank you so much for joining us today.
Sharon, I'm happy to attend and present. I am always a big proponent of charitable giving in any estate planning work that I do with clients. So I'm happy to support the cause for sure.
Well, thank you so much. And today our topic will be about tax breaks for the 2020 year. Is that what we'll be discussing?
Yes, it is. And in particular, a look back to the 2017 tax law, which had a fairly significant impact on certainly tax planning.
Wonderful. So we'll start with your presentation then.
Okay. So we can move ahead. Slide 2 has the contact information if anyone had any questions or follow-up queries that they wanted to raise. Happy to address those at any point. There's my email. And on the next slide, we kind of lay out what we're going to face in this seminar. So let's advance. And so what happened in 2017, and we call it the 2017 tax law because it was passed in December of 2017. It was effective in 2018, and it really was a major change in income tax law in particular, and estate tax law as well, actually. And it's important to recognize that I'm going to focus on income tax and estate tax issues. I'm recognizing that donors have many reasons why they make donations, and they're not all tax law driven, fortunately. So that is really a critical item to understand, that while I'm going to focus on tax law, I certainly in no way am suggesting that tax law should drive donations. And as I said, I'm happy to say in large part it hasn't, in particular in light of this 2017 law. So let's look at that law. As the first item highlights, it fairly significantly lowered income tax rates, and it fairly significantly raised the estate tax exemption. And why do we focus on income and estate tax law when we look at charitable donations? Because we have an income tax deduction that's available when a person makes a donation during lifetime, and we have an estate tax deduction for charitable donations made at death. So we look at both those tax structures with the thought of, how much are they motivating this donations? And I'm happy to report that because there was a lot of concern after the passage of the 2017 law that we were going to see fairly significant drops in donations. In fact, we did see a little bit of a drop. The research that I've looked at showed about a 2% drop in charitable donations in 2018. But in part, I think you can peg that to 2017 donations that were made as people sought to capture as much of a tax break as they could with the 2017 law having higher tax rates and therefore higher charitable donation deductions than existed in 2018. And it's also great to see that in 2019, what I'm seeing for charitable donations is that it actually recovered well, and in many respects exceeded the 2017 donation. So it's clear, and it's wonderful to see that people are donating to an organization's mission, probably more so than they're donating for a tax deduction. And that is really, great to see. The other research that I saw is that economic well-being is a very significant factor in someone's donation and their ability to make a donation. That is a real concern in 2020, given the economic stress that we're under at the moment. There are real concerns that we're going to have a drop-off, but time will tell. And again, to the extent that mission of the entity of that charitable organization is promoted completely and emotionally to the donor, hopefully the donations continue, notwithstanding the economic stress we're under. So in addition to the lower income tax rates and the higher estate tax exemption, we also were the new law, the 2017 law, incorporated a higher standard deduction. And this is important because it is through itemization that a taxpayer gets to deduct a charitable donation. To the extent that person is not itemizing, then they're not going to obtain a charitable deduction. We're going to touch on the 2020 CARES Act, which changes that a little bit. But for the most part, if a donor doesn't itemize, then they're not going to be able to derive a tax deduction for a charitable donation. As the screen shows, the standard deduction for 2020, so taxpayers filing in April of next year, they can derive a standard deduction of $12,400 as an individual, $24,800 as a couple, and it's a little higher even for individuals over age 65. And what goes into that standard deduction is as far as whether a donor is going to exceed that standard deduction, in which case then they're motivated to itemize. There are really four drivers as to whether a person is better off using the standard deduction or itemizing. And those four drivers are medical expenses, state and local income taxes, mortgage interest, and charitable donations. To the extent, and some of those have thresholds that have to be exceeded before a taxpayer can itemize. Medical expenses in particular has a fairly significant threshold that has to be met. But to the extent those payments and those expenses are going to result in a total amount that exceeds the standard deduction, then that taxpayer is motivated to itemize, in which case then charitable deductions are available to that taxpayer. And as I note in the last comment there, that I note the deduction caps. One item that I do want to emphasize, as I said, medical expenses, there's a threshold to meet. Charitable donations and mortgage interest, there are no caps, but there is a cap on the state and local real estate tax payment, and it's $10,000. So to the extent I pay $8,000 in income taxes and I pay $7,000 in property taxes, I can deduct no more than $10,000 as it flows into the itemization calculation. I'm capped at $10,000. And curiously, when a couple, many of the tax provisions that deal with couples actually double when they're factored into whether an individual is filing individually or jointly with the spouse. And this limit, this cap of $10,000 for state and local income taxes, or taxes, including property taxes, doesn't double. So a couple faces the $10,000 cap. And again, it's going to make it more difficult for them because they have a higher standard deduction, the $24,800, to actually exceed that standard deduction when medical expenses, state and local taxes, mortgage interest, and charitable donations are factored in. They may not exceed the $24,800, in which case they won't itemize. And there is a little bit of an income tax hit, if you will, that they will unfortunately not be able to capture a tax deduction for a charitable donation. You need to exceed the standard deduction in order to capture a charitable tax donation, except the CARES Act, which on the next slide we show that Congress recognized that this was an issue that many people were not going to be able to itemize their charitable donations because of the high standard deduction. And they included a special provision that's effective for this year. It was part of the CARES Act, that significant act that passed earlier in the spring to address the whole COVID-19 crisis we're under, the pandemic. And this provision only applies to the extent the taxpayer does not itemize. So it's clearly focused on those folks who would otherwise just use the standard deduction, make a charitable donation and not be able to deduct it. Now they can deduct it up to $300. It only is for gifts that go to public charities, so private foundations and donor-advised funds do not qualify. It has to be a cash donation, so it cannot be used to donate, say, stock. And it's a so-called above-the-line adjustment to income, which reduces the taxable income. That has some impact potentially for a taxpayer because adjusted gross income, the higher it is in some situations, there are tax effects that flow from it. But the $300 donation, charitable contribution, is actually above the line, but it is capped at $300. On the next slide, we also touch on another change that the CARES Act brought in, which concerns the ability to deduct up to 100% of a person's income on their tax return. This is more than likely going to have limited application. I don't know a lot of people who are going to donate every single dollar of income they have to a charity, but I think it could have relevance for, say, a retiree that wants to make a large donation, has a retirement plan that they're not needing to live on. They could potentially pull down a significant dollar amount from that retirement plan and make a charitable donation of all of it, and not have to face what had existed prior to the CARES Act, where they could not deduct more than 60% of their adjusted gross income as a charitable donation. There was a cap. To the extent that donations exceeded that 60% cap, then they could carry it over for 5 years, that donation, until it was ultimately used in full. But this year they can actually take a charitable donation of up to 100% of their income. Corporations also have a deduction of up to 25% of their taxable income. Again, this is only available for cash contributions. So that's going to be a little bit of a limiting factor, other than the retirement account situation, since in many cases, people who want to make a large gift are going to use stock to defer the capital gain that would be otherwise triggered if they sold that stock. So they just donate it to a charity. In those cases, they're not going to be able to take advantage of the 100% charitable deduction of AGI. And it doesn't apply again to private foundations and donor-advised funds. So those are the federal tax law aspects that we really need to understand as we look at tax planning for charitable donations. On the next slide, we talk about the Vermont Tax Credit. This again came into being as a result of the federal law. It passed in 2017, where it was very clear that many Vermonters were not going to be deducting charitable donations because they couldn't itemize. So the Vermont legislature passed a law that is a tax credit allowing a Vermont taxpayer, to receive the credit for it's 5% of the first $20,000 of eligible contributions made during the year, and applies whether or not you itemize. So this is a potentially $1,000 credit that can be available to a Vermonter who doesn't otherwise itemize, and that's, again, it's a great incentive. To the extent we need a tax incentive to make people donate, Vermont has incorporated such a tax incentive. Moving on, I just wanted to highlight the reality of where we are with tax rates for 2020. I think the vast majority of taxpayers are going to be at that 22,000 rate or below. These are individual rates. On the next slide, we have rates for couples, which, again, I think the vast majority of taxpayers who file jointly will be at 22% or below. So if that individual makes a charitable donation that they can't itemize, they get no benefit as far as on the tax return. To the extent they itemize, they will derive a benefit that essentially the government pays 22% of that donation, because they're going to save 22% if that's their tax rate on their tax return, which is lower than it had been prior to the 2017 law. One could argue that, well, the lower tax rate means people have more money and therefore more ability to make donations, which is absolutely the case. Moving on to the next few slides, I just wanted to kind of lay out some scenarios that I think kind of highlight the world we're in at the moment. Before we go into the scenarios, just to again emphasize that people who make gifts of appreciated property, so that second bullet, stocks being the classic, and it's a very beneficial asset to use, because, as I said, if it's a stock that has a lot of pent-up appreciation and therefore capital gain exposure, to the extent the stock is donated to a charity, the person gets to take a deduction of the fair market value of that stock on the date of transfer, but there is a cap as to how much of that donation can be deducted on a person's income tax return. This is, again, a person who's itemizing. It's a 30% limit on the amount of the gift. So if they exceed that 30% by $10,000, then the next year they'll have a $10,000 charitable donation available to them. This year we have the unique situation where there's the 60% doesn't apply. It's actually 100% if it's a cash gift. But the bottom line is that, as I say, and I mentioned, I apologize, it's just a reality throughout this presentation, that in that third bullet, that we have a dramatically reduced number of taxpayers who itemize. But given the experience we've seen since the 2017 law, it does suggest that many people are willing to make after-tax donations, which is just what we need for charities to be able to continue to rely on the donations that have existed in the past. So just kind of framing some situations with the next slide, we've got, and we have a number of slides after that where I just lay out situations just to give a flavor for how current tax law impacts different situations and different types of donors. So in this example, we've got a high income donor, taxable income over $300,000, state and local taxes of $27,500. So it's an individual. He or she is well above the state and local taxes. The $27,500 is now limited to $10,000. But even so, he's got mortgage interest of $15,000. So he or she is well above the standard deduction. So this person can itemize. The taxpayer makes a gift of $20,000, fully deductible, with the reality that this year, if that $20,000 equals even 100% of his income, he could do it. In this case, the taxpayer is well below even the 60%, since it's $20,000 compared to $300,000 of income. On the next slide, we've got a retiree, and this is one critical element that is emphasized, that we go into a little bit more detail on the back end of this presentation. But it's the reality that IRA giving is very much one that development officers should consider talking seriously with donors, because there is a real benefit to using retirement funds. So here we have a retiree. He doesn't itemize because he doesn't have any deductions that will exceed the standard deduction. He anticipates $75,000 of an IRA distribution, and as we know, at what had been 70 and a half, now it's 72 years of age, people need to start taking their IRA accounts, deferred income tax accounts, retirement accounts, at those ages under the so-called required minimum distribution rules. So this taxpayer has decided that he's going to, or she's going to make a $10,000 charitable gift and going to use that IRA. It's an ideal situation for this taxpayer. The taxpayer can use $10,000 of the IRA, pass it directly to the charity, and not have the $10,000 gift or distribution from the IRA included in the taxpayer's taxable income. And they can use that $10,000 to make what's called a qualified charitable distribution. IRAs are, in what we're talking about in particular here, are traditional IRAs, not Roth IRAs, since they don't have any income taxation associated with them. But a traditional IRA is going to be taxable dollar for dollar as the money flows out of the IRA. To the extent we can get that IRA over to a charity, then there's the charitable deduction. In the case of a qualified charitable distribution, it's the equivalent to 100% deduction, because we don't bring the income in as we typically would with an IRA. We also don't get a classic charitable deduction, but we don't, as long as we don't have to bring the income in, it equates to a charitable deduction. The other reality with IRAs is that at death, IRAs are taxed 100%, even though there's clearly an income tax allocation that's going to be made as that money flows out. Taxes are going to be paid on that money, income taxes. IRS says, well, we're going to ignore that. We're going to include that IRA 100% in the person's taxable estate, and to the extent that the person has a taxable estate and actually pays an estate tax, then passing that money to a charity results in a charitable deduction on the estate tax return. To the extent that the person doesn't pay an estate tax, the person's not worried about the deduction, but there is the reality that that charity is going to receive that money 100%, because the nonprofit, a tax-exempt nonprofit, doesn't pay income taxes. They're going to get it, the IRA, 100%, whereas any other beneficiary, a child, a other friend or family member, they are going to have to pay income taxes. The money flows out, so they are going to have a less than a 100% benefit. And to the extent a taxpayer has a charitable inclination, IRA assets are absolutely top of the list to be thinking about using one way or another, and therefore, as development officers, you should really think about people that have those situations and have IRA funds in particular of note. And there are people who do have very significant retirement account balances that have just grown over the years. If there's one reality that we've had in this COVID world, is that while the economy, the kind of day-to-day Main Street business is really struggling, the stock market is just having a banner year. And it's there's a lot of appreciation in IRA accounts. So it's definitely one to keep in mind. And then finally, on the individual front, we have the next, we have a high income person, 400,000 of income. They've got 150,000 IRA distribution. They've got, again, state and local taxes of 25, but they can only deduct 10. They want to make a charitable contribution of 100,000, and they can use the qualified charitable distribution if the person is over 70 and a half. One thing to note, the qualified charitable distribution that's available to the taxpayer with an IRA who's over 70 and a half is that it, unlike the required minimum, which did increase to 72 years, you don't have to start the required minimum until 72. The qualified charitable distribution was not raised. So at 70 and a half, a person can use that option, which is a very, very attractive option to engage in, and it will touch in more detail in just a bit. And then, as I said, he can, this person, even if they didn't use the qualified charitable, they can deduct in 2020 100% of that amount, to the extent we're at the 60%, and that's assuming it's cash. If it's stock, then it's actually 30%. But if it's cash, as of next year, it'd be 60% or 180,000. So now that I want to just look to couples and the impact that tax law has had on the couples. So here we have a couple both over age 65, income of $200,000. They've got a state income tax of $12,000, a property tax of $8,000, totaling $20,000. But under the 2017 tax law, even a couple is still capped at $10,000. And the standard deduction for a couple is $24,800. So to the extent they don't have another $14,800 of expenses that they could itemize, they will not be able to. They'll be better off taking the standard deduction. In this situation, they're contemplating a $5,000 charitable gift. They cannot itemize it, but what they can do, they can, if they're going to use the standard deduction, they still derive this year $300 charitable gift deduction on the federal return, and since they can deduct or receive a credit under the Vermont charitable law, donation law, they get a 5% credit, 5% of the $5,000 being $250. So there's been a lot of discussion about, well, what does a couple like this do? I mean, they have income of over $200,000 a year. They clearly are capable of making significant donations if they're so inclined. And what has been a recommended course of action has been to consider bunching, namely aggregating. This is what I think in part happened in 2017, where a taxpayer, looking at the reductions that were coming as of 2018, took action to perhaps make what a gift that they would have made in 2018 and perhaps 2019, and made them all in 2017, and then did not make donations in 2018 and 2019. They bunch them. You aggregate your charitable giving with a thought that it's going to then increase your potential to take a charitable deduction, because they're going to be high enough to make you qualify for itemizing. They'll be higher than the standard deduction will be less than what you could derive through itemization. And in this regard, people look to donor advised funds as a mechanism to also be able to essentially bunch. With donor advised funds, you quite often will see larger gifts made to the donor advised fund, thereby deriving that charitable deduction in the year of the gift, and then those funds are paid out as the donor advises over a number of years. So that's another way to essentially bunch and aggregate the size of the gift, and thereby increase the potential to be able to itemize. Moving on to the next example, here we've got a couple with a household income of $163,000. We have state and local taxes which exceed the $10,000, so we're capped there. But you see, in this example, we have mortgage interest of $15,000. So the $10,000 plus the $15,000 puts us over the standard deduction, meaning that we can itemize and actually derive an additional benefit. And as part of that itemization, we can include our charitable giving, which then puts us at $32,500 as a itemized deduction, which is thereby we derive a charitable deduction for the charitable donation. We can fully deduct the gifts. In the 2020 tax rate structure, it's a 24% essential benefit that results by being able to take that deduction. So that $7,500 charitable gift is essentially paid $1,800 by the U.S. government, giving us a deduction. And then finally, the last example is a couple with very high income, and they've got a capital pledge. The stock is subject to appreciation and capital gains. So they're going to use that stock to satisfy that gift. This is a classic situation where it makes total sense to use that stock, avoid the capital gains, derive this $300,000 charitable gift. The downside is, since we're not using cash, we not only do we not get the 60%, we clearly don't get the 100% AGI. We're at the 30% AGI limit. And I'll note here that 30% AGI limit, that did not change under either the CARES Act or the 2017. That 30% AGI limit has been around for quite some time, so people and accountants are very much aware of that. But they are able to take a charitable donation deduction. They just are going to have to do it over a period of time. So one other item in connection with that, this couple on the next slide, we've got the fact that they could, if this were cash, they could take a full $300,000 deduction in 2020. But since it's stock, they cannot do that. The reality is that at a 37% tax bracket, which is what they're in at the income level they have, the 300,000 gift results in a $111,000 income tax deduction. So now I want to move on to IRA accounts with some specificity, because I just cannot emphasize enough that retirement assets are that, in particular, the deferred income tax, not talking Roth, but the traditional IRA assets should be priority number one. When I'm counseling clients, if there's any charitable inclination, I point them to the retirement accounts as a mechanism to fund that charitable inclination. So as part of that, and that, I should say, applies if I've got a 50-year-old who has charitable wishes, I'll recommend the IRA to satisfy that. In particular, if I've got an older client and one that's over 70 and a half, then for certainly testamentary or gifts made at death, absolutely want to talk about using the IRA to satisfy those testamentary gifts. But also with the reality, if it's an individual or a couple that is not going to be able to deduct their charitable giving because the standard deduction exceeds what they could otherwise itemize, then the option of using a qualified charitable distribution is top of the list as far as things to consider. Because again, we can take this taxable distribution, what would otherwise be a taxable distribution, and not have to bring it in as taxable when we push it over to a charity. So the qualified charitable distributions are really attractive for folks who are not itemizing, who are over 70 and a half, and they want to continue annual giving. It's just ideal. So let's really kind of drill down in to fully understand it. We have a cap. It's $100,000 per year from an IRA. A couple could do $200,000 if they each had IRAs and they each were going to take this action. You're not required to report the income. It's literally as if it never happened. So you don't even have to bring it onto your income tax return. It cannot be used for donor advised funds. So you couldn't. The distribution has to go to a qualifying charity, and a donor advised fund is not a qualifying charity. One issue that comes up in particular, if I've got a client who isn't making very large gifts, however you want to quantify that, but say $5,000 gifts, some brokerage houses actually allow the plan owner to have a checkbook, and they could just literally write checks to the charities to satisfy their annual giving and qualify for this qualified charitable distribution. There were some changes in IRA law discussed on the next slide. And again, I think it's going to be of limited benefit, but in the right situation, it could be ideal. But someone can deduct up to 100% of their income with a charitable donation. This is not a qualified charitable distribution. This is a situation where the person is going to, if it's an IRA account, they're going to bring that IRA distribution onto their tax return and then show the charitable donation as an itemized deduction. And they can make that charitable deduction up to 100% of their AGI. There's a 59 and a half age requirement because prior to that, you would start triggering penalties for an early withdrawal from an IRA. But if the person's over 59 and a half, the IRA is theirs to control, and they could take down however much they want. As I said, declare that distribution on their tax return, but then take up to 100% of their adjusted gross income as a charitable donation. And it's important on the next slide, we highlight in detail this qualified charitable distribution, because I think this is where, as far as retirement accounts, this is what we're going to see most often, other than a testamentary bequest using a retirement account. But there are, I've laid out 9 requirements, 5 here and 4 in the next slide, and walking through them, the donor's got to be 70 and a half, again, not 72, even though that's the new required minimum distribution age. We're talking IRAs only, so we're not talking profit sharing and 401k plans. It's got to be a distribution directly from the IRA to the charity. We've got ineligible charitable recipients, non-operating private foundations, donor advised funds, and tax-exempt supporting organizations. As is the typical with a charitable donation, there can be no financial benefit to the donor, because that would otherwise reduce the income tax deduction. And then I've set forth 4 more. It's only available for the taxable portion. There is the possibility, many people don't use it, but it is the case that you can donate to an IRA, to a tax-deferred IRA, after-tax money that then would not be taxable as it's withdrawn, because it's already been taxed. But this is not available for the after-tax payment. It only applies to the taxable portion, which is really the portion that we're most concerned about as far as income taxation. We've got a $100,000 limit as a couple. It could be $200,000 if they both have IRA funds that they're going to use. It's got to qualify in all the standard methods. It's got to be supported and is substantiated by a receipt from the charity. And again, no benefit derived in connection with the gift. And then it's not reported at all, but it is there's an exclusion that you would just notate on the front of the tax return. So just a few final points and the items to think about. Split interest gifts, again, this right after the 2017 tax law, there was a lot of discussion about people, as I said, using donor advised funds to make large gifts, to bunch gifting into multiple years of gifts made in 1 year. There was also discussion about using charitable remainder trusts, which are trusts that are created. The taxpayer typically derives an income tax benefit for a period of years, and then when that ends, the trust is distributed to the charity. The attraction is that it's a mechanism whereby a taxpayer could make a large transfer of funds into a charitable trust, still derive a benefit because they get an income stream, typically 4 or 5% of the charitable trust, and then it ultimately passes to the charity. The appeal is that it can be a large amount, and since the taxpayer is not losing full access, they actually still derive some benefit. A taxpayer might be more inclined to make such a gift. The actual amount of the gift is the remainder interest calculated based on the IRS tables, and it's typically, with a large gift, going to be a fairly significant amount, and it may well allow the taxpayer to itemize on in the year of the gift. So final thoughts. As I have mentioned throughout this presentation, that we do have the deduction caps, the $10,000 on state and local taxes, which then lessens the ability to itemize. We've got the higher standard deduction amount in and of itself, which also means that few people need or are able to itemize. And so the issue has been, how much of charitable giving is motivated by income tax. And I'm happy to report, given what I've read of late regarding 2018 and 2019, that giving held up well. And what appears to be a bigger driver for giving is the well-being of the taxpayer. And unfortunately, in 2020, that is a big question mark. Folks who have a lot of money in the stock market, I think on average, on par, doing very well. The stock market today may be exceeding its high ever. Folks who are more, working for hospitality businesses and the like, they're in a whole different situation, and they're going to be much more stressed financially to be able to do a lot of giving. But as I mentioned, there are a couple new provisions: the CARES Act, the $300 donation that taxpayer with not a lot of money and therefore presumably going to use a standard deduction can still take a $300 deduction, and then there's the Vermont Tax Credit as well. But very much top of mind for folks to think about is IRAs for both testamentary gifts, because they do result in the charity receiving 100% when any other beneficiary of a traditional IRA is going to have to pay an income tax as that money flows to them. And certainly for lifetime giving, the qualified charitable distribution is very attractive. So hopefully 2020 is going to be not as bad as it could be, and the giving will still maintain, but it's a challenging time, to say the least.
Thank you so much, Mark. We really appreciate you going over the different tax benefits and what people can do to maximize giving at this time of year. Just a few questions. When you were talking about the 100%, tax deduction, charitable on a charitable gift of your income, if someone gives all of their income, does that have to be just one person if you're filing as a couple, or does it have to be, like, if you're filing as a couple, both people to reach that AIG?
It depends on whether they file jointly or individually. It's going to be 100% of the adjusted gross income on that tax return.
Okay.
And whether a wealthy spouse makes the entire gift, which equates to 100%, or they split it, but it's all driven by that tax return, and there is no need for both of them to kind of do it equally if it's a jointly filed.
Okay. And then when we talk about the $300 deduction, is that for an individual, or is that total for also a joint?
Great question. And this is one that there had been some confusion, because again, with most tax provisions, if it's an individual at X, a couple is 2X, whether it's of whatever sort in the tax code. Unfortunately, the $300 is per return. So if a couple wants to have 300 each, they would need to file separately. If they're going to file jointly, it's a $300 amount on that return for that couple.
Okay, great. And then you talked about tax-free gifts made through the IRAs.
Mm-hmm.
What's the benefit of doing a tax-free gift to the donor?
The major benefit is that they essentially capture an income tax charitable deduction when they might not otherwise be able to capture it, because their total donations and deductions are below the standard deduction. And it's tax-free in the sense that if I take a $10,000 IRA distribution, a traditional IRA, I've got to declare that. I've got to say to the IRS, okay, I've got $10,000 of extra income. And to the extent I don't itemize and I give the $10,000 to the charity, I'm not going to be able to capture a deduction because I don't itemize. With the qualified distribution, a charitable distribution, I don't have to bring in that $10,000. So when that $10,000 goes to the charity, it's as if I had a total tax-free deduction, because the $10,000 doesn't hit my account as taxable, but the charity is able to receive it 100%.
And then you can deduct that from your taxes as a charitable contribution.
You don't need to deduct it, and you can't, because you don't have to bring it in. So it's as if it's a wash. It's a wash. So you essentially get a charitable deduction, but it's kind of as a side deal of a sort. You don't bring in the income, but you don't get the deduction. But it's equivalent of a 100% charitable deduction when it's all said and done.
Wonderful. So I have no other questions that have come in, or that I have. So I thank you very much for joining us today.
Sure.
Any final thoughts?
Just, when I meet with clients and we talk about charitable giving, the motivation is the mission of the organization. It's not, we talk about the tax realities, and in particular, I talk about retirement plans if we're going to incorporate charitable giving. But in large part, I regularly say to clients, don't let the tax code drive your life. And if you believe in that organization, then it's more the mission than the tax deduction that really should be the deciding factor.
Wonderful. Well, thank you again so much. We really appreciate you taking the time to talk today.
Happy to participate.